returning guest. But we have some interesting stuff to talk about. We were talking just a second ago about how interesting of a time we're at right now with where the markets are. And so we'll dive into that a little bit. Before we get started, there's just a couple of items of business. I have to keep the lawyers happy. So let's go ahead and do that. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell any security, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading securities. Metastock, the Traders Forum LLC, and their employees and their guests disclaim all liability for investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock, the Traders Forum LLC, their employees and guest speakers do not endorse the purchase of any particular security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. This is the first Ticker Talk that you've watched, I just want to let you know it's a little bit more of a longer form session. It's more of a bit of a podcast style. If you're looking more for something a little bit more instructive, it is going to be awesome. We're going to talk a lot about kind of what's going on in the market. There's a lot of support being tested out there right now. We're going to talk a little bit about that. We're going to talk a lot about how John and Jack got involved in the markets and all that kind of stuff. So if you're not in the mood for a longer form podcast, you could come back later. But that's what we're doing. It's a bit of a longer form as today. In addition to that, if you are watching the channel, like and subscribe. It helps a great deal. We appreciate it, and it helps us keep bringing great guests and great content like that. If you haven't yet, the other thing I'm going to say is join our community. We have a growing group of traders. We get in there, we chat about the markets. There's education. There's all kinds of resources that are available. We've been working on it for a little bit now, but it's growing. It's getting bigger, and we really enjoy working on the Traders Forum. And I'd love to see you at www.thetradersforum. So, and with all that being said, our guests today are John and Jack Asbury, Research.com. And I'm going to actually, as I usually do, ask them to introduce themselves and talk a little bit about what they do. So let me go ahead and stop sharing the slides. You can see them. Where's my mouse? Oh, it's over here. Okay. You can see them. How you guys doing today?
Good. Doing okay. It's a wild day at the markets.
Oh, for sure. Why don't you give us a little bit of an introduction to kind of who you are and what you guys do and kind of the services and the products that you offer. Just kind of give us a little bit of background details, if you don't mind.
Sure. This is my 43rd year in the business. I spent almost 20 years on the floor of the Chicago Mercantile Exchange in Chicago, the CME, back in the 80s and 90s. So my perspective, I think, to this day is a lot more practical rather than academic. Left the floor in the late 90s, started Asbury Research in 2005, selling research to institutions, different types of money managers, various portfolio managers, some commodity trading firms, CTAs, pretty broad swath. We started working with individual investors 10 years ago as a result of Fidelity inviting me to give educational webinars to their elite customers, older, wealthier types. This is my 10th year of doing those. Fidelity keeps asking us back. It's been really good for us. And we started managing money about a year ago. And Jack actually has been helping me build quantitative trading models for close to a decade, but now he's here full time, and I'll let him kind of explain his background and where he comes from. It's quite a bit different than mine.
Yeah, so it's kind of the yang to his yang. So I'm a little bit more from the academic side. I got a master's degree, master's of science finance from Illinois Institute of Technology. For the last decade, I have bounced around between insurance companies, tech companies, and large banks, kind of doing everything under the sun in terms of back office, middle office, and even some research and analyst type work. came over. I've been watching charts since I was about 10, kind of sitting in the back. So markets have always been kind of in the back of my mind, even if it wasn't always my focus, but full focused on markets now. And yeah, we don't go fishing. We build models together. So we've been doing that for a while, and we're kind of data heads and really like to dig deep into the numbers. And it's what we do for fun.
Pays way better than fishing.
Yeah. Well, yeah. Cool. So, with the research models, obviously you do research. Typically, how many research papers are you doing? Kind of give me an idea of kind of like what that looks like.
Models or papers? Research or we talk?
What type of stuff is your day to day? Yeah, are you in terms of just kind of explain to me kind of what your core product offerings are and kind of like what they look, if you don't mind.
Yeah, we're a data driven research shop. Our models are basically answer two key questions. Should I be invested in how much? And the other one is, what should I be invested in? Where should I keep to buy? And we try to answer that question. We try to outperform whenever we can. So we're typically with equities, we're looking at the S&P 500. And our question is more specific. What can we be buying with a better chance of outperforming the S&P 500? So while the sun's out and the market's going higher, ideally, it's nirvana for us if we can, if we could be in the market fully invested and also be in places that are outperforming. Our core to everything though really begins with the models, and then the research kind of fills in the blank and gives a little color to the models. I'll let Jack talk about our models. We have 2 benchmark models and we built other ones from those, but Jack, maybe you want to.
Yeah, so we, our main models, we have our CPM, which is our correction protection model, and we have our SEAF model, which is our sector ETF asset flow model. CPM is we call it a dynamic stock bond allocation. And that's, when we're risk on, we're full in the market, we're in SPY, S&P 500. And when we're risk off, like we are right now, we are in a 1 to 3 month, it's called BIL, it's an ETF, 1 to 3 month interest rates. And we kind of do that dynamically. So we're the opposite of a 60-40, equity bond split. CPM is really focused on being in the market when you want to be and being out of the market when you shouldn't be. Our SEAF model is our sector rotation model. It tracks the 11 sector spiders and really calculates the velocity of money going through those 11 sectors. The idea being that, we use the 11 sectors as kind of a whole pie, and tracking, knowing that a lot of investors have to be invested in the market, can't go to cash. They have to put their money kind of where they see opportunity, and we track that through our SEAF model. That really kind of dictates what sectors that we want to be involved in.
Okay, and so just to make sure I heard it right, you are risk off right now.
We are currently risk off.
Okay,
we've been risk off since February 21st is what Asbury 6, which is another one of our ancillary model. Asbury 6 turned negative on Friday the 21st.
Okay. In the sector rotation model that you're using, are you typically looking at individual stocks, or are you just saying, hey, you should be looking at transports, or you should be looking at this ETF? I mean, typically, if I'm a subscriber, I'd love to actually see your guys' paperwork, actually. But if I'm a subscriber, typically what detail do you go to? Are you telling them a specific company that they should be looking at, or just these are the sectors?
Yes. So we avoid particular companies. Our clients tend to be a little bit older and a little bit more risk averse. Find that individual stock risk can be difficult to maintain over long periods of time. So the way we tell our clients, what Chief does, it gives a ranking of all 11 sector sliders. And based on the ranking, the top 3 go into the model, but it also tells us where to avoid or where to go. So for right now, I believe our model is at XLF, XLC, and XLV, which is financials, communication services, and healthcare. We will recommend that our clients what they do with that is more or less up to them. We try to, some of our clients do pick individual stocks and they use Steve as a filter material. So they'll know that within those top 3 sectors, if they like any stocks in those particular rounds, that is a good place to be because they got money at their back. On the flip side, we kind of use the bottom half of the rankings to tell clients where to get out. So they might look at their holdings and say, technology might be toward the bottom. They might be a little bit heavier in tech on their portfolio. That might be a trigger to them to either come out of tech completely, take some profits that they need to take, or, use it as a place to avoid. And that's, we like to use that tool as kind of a top-down approach for our clients. We don't want to individually tell them what stocks to be in, but what sectors to look at, and then they could use their own tools to drive their stock selection.
When you're looking at kind of the industry or the sector-based analysis, are you using more technicals, or are you looking more broad market fundamentals? Are you basically ranking them on performance? Can you give me a little bit of idea of how the sector ranking works?
Sure. The initial idea that I had 10 years ago, I had built a momentum-based model that was working really well for years. And then as computerized trading became more and more to the forefront, I think that was probably a major catalyst for that. Sector rotation sped up a lot. 10, 8, 7 years ago, I don't remember exactly, but there was a definite kind of line of demarcation where these sector rotation outperformed trades went from lasting 1 to 2 quarters to lasting 6 to 8 weeks in many cases. Everything got faster. So I had to come up with, I either had to stop offering sector rotation as a part of our services, or I had to get more agile. So I started playing around with different ideas, and I came up with an idea of what if you could measure the acceleration of money, AUM, that's moving in and out of those 11 sectors, sort of like a monopoly game, right? If you look at the 11 sectors as the S&P 500, and you're watching, hotels on, the purple one, and then on the red one, the Illinois, and those, the businesses, the money is kind of moving around the board, kind of like that. So I had an idea of how we could measure not the dollar amounts, but rather the acceleration of the money moving in and out of those 11 sectors. I threw it at Jack. Jack's the math guy here. And before you know it, we had our first version of Steve. So it's based on asset flows, and more specifically, it's our own proprietary algorithm that measures how fast money is moving in and out of the 11 sectors.
I'm curious as to when you noticed that acceleration occur. When did you make those changes to the model approximately?
Probably about 10 years ago.
Okay.
But it was abrupt. I mean, it was abrupt. I had a momentum-based model that was based on relative performance. That was really a simple model, but killed it like for 3 or 4 years. And then all of a sudden it stopped working. And I'm like, well, what's going on here? Everything sped up. Those trends that I was catching, again, that were 1 to 2 quarters in length, they weren't, 6, 7, 8 weeks if I was lucky. The money got faster. I think the market more sophisticated, the velocity of trading, the ability to quickly trade, not have to call your broker, but, to be able to plug your trades in. Everything got smarter. Everything got more technologically adept. And I think that was the catalyst for that. Who knows? I mean, all I know is, but I don't know why.
A lot of people talked about how during 2020, things got a lot faster. Have you noticed velocity increase since that 10-year mark?
No, I really haven't.
Okay.
Steve's been around for 6 or 7 years, and it's been a steady performer. Sector rotation is a funny animal. When I explain sector rotation to some of our retail customers that don't really understand what it is, we speak in metaphors around here. We do a lot of explaining that way. So I explain it like a horse race with 11 horses in the field, and going around the track is 1 year. In a normal market year, those horses are going to stay in a pack, and they're going to go on the track, and a horse or two might win by a length or win by a head, but you don't get this breakaway. Much like when you go to the track to watch a horse race. But those years that one or two of those sectors break out of the metaphorical pack of horses and they win by 8 lengths, those are the years that we do really well. In 2021, we outperformed the S&P by 20%. In 2022, which was a down year for the S&P was down 19.6, and we were up 8.4% for the year. So we outperformed by 30% that year because XLE, if you recall, that year, the first half of the year, energy broke out of the pack, right? It just took off by itself. And we made so much money in energy in the first half of the year that we ended up outperforming the index by 30%.
Oh, nice.
S&P, yeah.
Yeah, very nice. How often do you update your sector data? Is it something that you look at daily, more than once a day, weekly?
We rebalance the model once a week. We find that daily moves are a little too erratic. You're trying to track money throughout the different sectors on a daily basis. You're going to end up getting whipsawed. There's a lot of movement midweek. So we try to track on a weekly basis. That's when the model gets updated.
Cool. Are you looking at weekly data then? Are you looking at kind of the open, high, low, close weekly data? Or are you looking at the
tracking the daily data? We have our internal algorithm that's actually going through, the different data series, but the data's coming in once a week. We rebalance the model weekly. So we are looking at daily data, but it's not something that, we're not changing signals every day.
We're looking at the daily data to judge how well the model is working, right? Day to day. Our algorithm might tell us that there's a big flush of money in multiple time frames that's gone into XLP, just, looking at the data and the relative performance of XLP versus SPY day to day tells us if it's working, basically. Because if it's working, now there's other things that go into sector rotation just besides asset flows. There's interest rates and what's going on in Washington and a million different stimuli that are forcing these sectors up and down. But yeah, the signals come from asset flows and the open, high, low settlement data, open, high, low, close data, and the relative performance of those sectors versus SPY tell us if it's working. Just know how our model's doing, really.
Now, last week you guys were at our conference, and you did a you did a great job. Thanks for coming to the conference. I'll find the link for your session in case someone wants to go back and watch it. But one of the things that you guys were talking about that stood out to me was you brought up a graphic that showed performance of the U.S. versus other countries. I want to talk a little bit about that, if that's okay.
Sure.
Go ahead.
You're going to finish?
Let's kind of set the table a little bit more too. In general, the graphic that you showed listed what countries, not companies, but what countries were outperforming the U.S. And I showed a couple of different time frames. What's that?
You like us to share our screen or just?
Sure. Yeah. Do you know how? It's just there's a square box with an arrow that points up.
There we go. Yeah, let me get the page up that we want to look at so you don't have to fumble around looking through my entire hard drive. I'd like to find out where we want to be. Okay, let's try this. I lost him. I'll let you drive. I have to let Jack drive here. I'm not.
No worries. Yeah. It's always good to have a kid.
Yeah. So
good.
This is,
talk us through this a little bit.
Sure. So we've got a lot of tools and models in our research center. One of those is called U.S. versus the world. And all we do here is we look at 25 different foreign or non-U.S., I should say, equity indexes. So we've got South America here, continental U.S. here. This is Western Europe. This is where most of the activity has taken place, really, for this particular move. We've got Asia Pacific here. We've got Oceania down here, which is the islands, New Zealand, Australia. There's a few more in that group. And then we look at them in 3 different time periods and how they're doing versus the S&P 500. So typically, in a normal environment, the S&P 500 leads most of the time. So most of the time, this graphic is going to be mostly white because you can see the U.S. here. The U.S. is the norm. So if the U.S. is leading all the way across the 3 different time periods and all 25 of these ETFs, this is going to be all white. So now you see this green and bolded. So you can see Germany, EWG was the first one. And we put that idea out. You can see 121 of 2025. We went long overweight Germany. We actually exited this one for a profit. Let's look at Italy because we're still we're still long Italy. That's EWI. You can see it's up 5% outright, up 5.9% versus the S&P. I don't know if you could show me charts. If you can use Metastock to bring charts up, we can look at some of those. But the way they display in the model is, here's Italy. It's been outperforming on a tactical basis since January 7th, and it's been outperforming on a strategic basis, which is 63 days or a quarter since January the 14th. So we kind of watched this model populate, start to turn bold and green going across the screen. And you can see we've got some ancillary stuff here. We've got China, Peru, and Canada. But generally, most of this outperformance has come from Western Europe. So the purpose of this is when the S&P 500 is going sideways, which it was doing really since about the second week of December of last year, oftentimes that money that equity-related investment dollar, it starts looking around the world for something that's going to do better than the S&P 500. And what happened here is it started in Western Europe, and it eventually kind of worked its way through the world.
And are these symbols or these ETFs? Are these actual tradable instruments?
These are all tradable ETFs. You can see all of them here.
Okay.
So Italy, it's EWI. Germany is EWG. You can see them up and down the lineup here. So yeah, they're generally, we try to pick more actively traded ETFs. They're from a few different ETF originators. Or 3 different ones, but we tried to get the ones that had some AUM in them and they had some activity. There's a lot of ETFs, as you all know out there, that don't do a lot of trade. And people are very worried about going into these ETFs that don't have a lot of volume. A lot of them are linked to an index, so they're not going to drift very much, but these are more heavily traded, let's call it.
If you want, I can actually show a chart if you want me to, or we could kind of move on to. It's up to you.
Yeah, let's have a look because I think seeing them on the table doesn't really do them justice. Like show EWG if you can, and can you pull up a relative performance chart on the bottom that shows EWG or EWI is fine, but let's see it on the bottom panel versus SPY.
Okay, for sure. Let's see. I'll just give me a second to set that up.
Okay. That's one of the things I really like about Metastock is it's so flexible. It's so versatile. You can just make a lot of different screens. And I have this thing where I've had 8 different screens on the same chart.
Yeah, you run Metastock like a tank, and it's good for that. So we've got S&P up here. I'm going to actually just change it to candles real quick and make it a little bit thicker so people can see it a little bit better.
But what I want is the relative performance of SPY, of EWI versus SPY. So it's just going to be a line, relative performance.
Yeah, let's do this.
SPY, and then you really be able to see how this is. It started in a hurry. It started about the second or third week of January, and then it took off from there. So we wait until trends are established, so we're usually looking at a moving average of sorts. What we got here? So you've got, so that's the S&P, and there's relative performance.
Yeah. I'm still working on it a little bit.
It's about, there you go.
I just wanted to make that a little bit bigger. So I get rid of SPY.
Yes.
How it performed.
So look at the middle of January vertically. Look about the middle of January vertically. Right around there. Right around where you are. That's
right
where these little signals started to turn into trades because they started to break some moving averages. We started to get some trend. So you can see up top is EWI from the middle of January, which is kind of right off the lows that we made back in December. Started kind of a double bottom, if you will. You all can probably see that in the last third of the chart up in the top panel. But look what happened down at the bottom. As EWI, Italy equity index started to stabilize and make a double bottom, look what happened to relative performance. It started to really crushing the S&P 500. So this, from where we got in this idea, which was latter part of January, very early February, we've outperformed by like 12 or 15% already. So do these trades show up all the time? No. Most of the time, the U.S. is going to lead the world. But when the U.S. is struggling, when there is uncertainty in the U.S., like we've had with the trade wars and the tariffs and all this stuff coming out of Washington and a new administration, the U.S. market does not like uncertainty. So we use our U.S. versus the world model, tell us what parts of the world that we could take some of our exposure in the U.S. and move it overseas and see if we could pick up some outperformance while the S&P 500 is trying to figure things out. So that chart looks just like EWG and some of the other ones. So
here comes AWG.
Yeah, here's your EWG, and let's stretch out that bottom one a little bit. There we go. Again, look at the middle of January. That peak on January 21st is where we entered that idea. And through this morning, it's outperformed the S&P by 20% in, 6 weeks? So
looking at this chart compared to anything that's an index in the U.S., I'd rather be in this one.
Yes. So in a year like this, where we don't know, I'm looking up at our screens, the S&P is down 104. We don't know if this is going to turn into a bear market or what's going to happen. But while the U.S. is kind of wringing its hands and figuring out what to do with all this tariff talk, we were able to move some of our equity exposure overseas and take advantage of an opportunity that doesn't really show up every day, because it's not typical for the U.S. to underperform this much this fast.
Now, you had, before we started, you were kind of talking about 150. You were kind of starting to talk about something that was interesting to you. And I said, let's hold off. Let's talk about it during this session. We're talking a little bit about the work you were doing for, you look at 150 charts a day, I think is what you're saying. Why don't we pick up that?
Yeah, what I was talking about is one of the reports that we do, and we could show that report if you want us to. It's a weekly report. It's keys to this week. And did you want to see me call that up? So once a week, we do an overview of the U.S. equity market. It's keys to this week is the name of the report. You're inside the research center now. and we're going to go right there. So we look at a lot of stuff. We look at a lot of data. We look at a lot of unusual data that other people probably don't look at very often. But so let's just say hypothetically, we look at 100 charts, 150 charts, and we ask ourselves, which of these charts are the most important to the market right now? And we kind of filter that down to 10. And what this graphic shows is, of those 10, where is the most weight of evidence? Like if you kind of looked at this like a scale and there was I don't know if you could see my mouse move.
We can.
But if you put a pin right in the middle here and saw this as a scale, the most entries are here on tactically negative. So tactical for us is 1 month, and you can see there's more stuff here. We got volatility, we have market internals. So that means right now, the most compelling part of the market directionally is tactically negative, market going lower. And then we show those charts. So we've got the S&P 500 here. We're showing support down here. This is this major support level that the market's doing backflips on here for the past 2 or 3 days. We're up 100. We're up 100 and down 100 now. We were up 100 yesterday. We were down 100 the day before. There's a reason for that. The big support level here. And then we go to the NASDAQ and we point out the composite NASDAQ. That's the bigger of the two NASDAQs, sitting on its 200-day moving average, this orange line, for the past week. Major support level. We had a breakdown from a chart pattern here, the end of February, that suggested that we were going to go down to 18,100. We hit that 2 days ago. So the initial expectations from this breakdown, from this indecision, has already been achieved, but now we've got to hold this trend. This trend dates back, by the way, to February of 2023. That's a two-year major trend. If this trend gets broken, it's going to be fireworks. There's going to be more fireworks than we're looking at today. Jack, did you want to take some of these? Here we have Apple sitting on its 200-day. Again, I don't have. I got it. So Apple is Apple has biggest market cap of all U.S. stocks, $3.2 trillion, $3.3 trillion. Look at all of this activity around the 200-day moving average. The market sees it. The market's negotiating it. Apple, because it's so big, it has a lot of sway over all the indexes, the tech indexes and also the broad indexes. So 3 different indications that we're at a big support level. There's actually more that I've listed up here that's probably worth mentioning. All of these indexes are all sitting at a major support level right now. We looked at the S&P 500, the NASDAQ comp, the NASDAQ 100, which is NDX, the Russell 3000, IWV, NYSE composite index is NYSE, S&P 100, OEX, Philex Semiconductor Index, that's the SOX index. For those who trade the semis, S&P 1500, SPTM is the ticker. It's the total, it's the combination of the S&P 400, 500, and 600, which is small, medium, and large cap. And then we have Apple, Amazon, Alphabet, Microsoft, and Tesla. All of those are on their 200-day moving averages or on a major trend line that originated a couple of years ago. That means if you're a trader, you've got some risk reward out. You can say, I can buy this and risk this much so I can make that much. So the risk reward is there for those that are doing this professionally, yes, because if you're wrong and we break these trend lines, you're going to get out of there with a relatively small risk. And if you're right, you bought the bottom, and we may be making all-time highs maybe in a year, 6 months, who knows? But the fact is that's where the risk reward is. But other stuff that we're looking at is not showing us anything good tactically. This is our Asbury 6. This is our indicator that tells us the daily internal health of the stock market based on 6 different indicators. We look at the rate of change in the S&P 500. We look at the relative performance of stocks versus high yield bonds, investor asset flows, volatility, trading volume, and market breadth. They are all negative. That's why they're red. You can see they all turned, with the exception of investor asset flows, they all turned in between February 20th and 21st. So we've been negative on our metric for about 3 weeks, and the market's down about 6% since this told us that we need to be careful. Volatility. Look how high the VIX is relative to where it's been over the past few months. When the VIX goes up, the market gets fearful and the stock prices go down. So as long as the VIX stays elevated like it is right now, that means that the market is fearful and unlikely to have any kind of a rally that's going to last any more than a day or two. We look at how stocks are doing versus bonds. AGG is it's got a very long name. It's the iShares Core U.S. Aggregate Bond ETF, AG. When stocks are outperforming bonds, SPY is outperforming AG, as it was all through here. Stock market like that, and it went up. Look what's happening now. It's been underperforming SPY, or stocks have been underperforming bonds or AG since the last week of February, and look what's happened to the market. As long as this underperformance sticks, the market's going to stay weak. This is seasonality. Seasonality is actually good during April. The 4th and 2nd strongest months of the year in the S&P 500 going back to 1957. Large cap is outperforming over the other two. You don't want to be in mid or small right now. The trend is towards the large cap stocks. We just switched over to value. Value is outperforming, has been since the middle of February. When value outperforms, it generally means that the market is in a defensive mode. There's no blitz in the stock market. There's always a shift, but generally speaking, value is kind of a defensive place to be, and growth is an offensive place to be. And here's our version of EWG. You can see where we got into EWG on January the 21st. EWG has risen by 14% since then, and it outperformed the S&P, which is more important to me to be able to catch this opportunity when the S&P is getting beat up right now. We outperformed by 19% in a month, less than a month, about 6 weeks, something like that. So that's what this comes out once a week, and this is one of many reports that we do.
Which report is this? I find this one really interesting, particularly the wording. Keys to the week. Okay.
And we also have a Substack. We have a Substack newsletter. It's asburyresearch.substack.com that has a variation of this report there. So that's another place where you could find something that is like this, where we look at a selected small group of stock that together tell a story. You can see everything is testing major support. That's the
exact URL for the Substack.
It's substack.com/Asbury Research.
Okay, thank you. I wanted to get that in the notes.
Yeah, if you just search Asbury Research Substack, it should be able to bring it right up on a search if you use Google or whoever you use for your search engine.
Okay. So we kind of looked at all the things, and I kind of have that impression too. We're kind of sitting at a lot of 200 moving averages, right? If you look at the indexes, everything's being held. Is there anything particular? Now, you kind of listed about 6 things. Is there anything, at what point are you going to say, okay, well, it looks like we're going to hold these moving averages or these support areas? Are there specific things you're looking for to see if aside from them completely going down, through them and kind of violating them. So are there specific key metrics that you'd want to see to kind of say, okay, well, it's a good time to buy the dip. Maybe the market's going to start to recover from here. Or is it just a combination of all those 6 items?
Of the 6,
Is it?
and we're talking about the Asbury 6 now, right? That's what we're
Right. Mm-hmm.
Yeah. Typically, the most sensitive one is the VIX,
Okay.
one of the Asbury 6. The VIX is really fast twitch, right? Yeah, the market scared as it's been all week, and that VIX jumps hard. The market gets calmed down, things are quiet, maybe things in Washington settle down, whatever it might be. So that VIX, to me, that's like when you go into the doctor's office, first thing he does is he takes your pulse, because, you could walk in there and you got a new shirt on, your hair's combed, and you might be racing inside, and he can't see that until he puts his thumb on your wrist and takes your pulse. I think that is probably the most sensitive to day-to-day market feelings. But those other ones, I'll let Jack talk about some of those other ones. I kind of liken it to if you walk into an art museum and there's a sculpture in the middle of the room, and you look at it from one angle, and you might have an idea in your head of what it might look like, or if you like it. But if you go around the room, you look at it from 6 different angles, you get a much better indication of what that thing is, how it looks. Do you like it? How is it shaped in the back? That's what the Asbury 6 tries to do, is try to look at the market from 6 different angles, because sometimes 1 or 2 of those angles are going to be really deceptive. Sometimes every indicator has an Achilles heel. Certain indicators, every indicator has times or periods or economic environments where it doesn't work very well. So that's why we look at sticks.
Yeah, loosely, we look at the A6. We want to see kind of 4 green to turn. So, if you're, for 3 and 3, we're kind of, we tend to notice we're on an inflection point when we're looking at the charts. So they're, it's kind of teetering right on that level. And we look for that 4th one to kind of push us over the edge. The reason it's 4 instead of all 6 is because if, anybody that's out there that's trading knows that if you're using an indicator, that even a good indicator that works 80% of the time is going to fail you then 20% of the time. And then you end up getting yourself offside. Or you'll have some lagging indicators that might not react right away. So you'll have times where, you can see 4 are green, but 2 are going to stay red. And they might stay red for another extra 2 weeks. They can go off into the wilderness. There could be a economic effect that is causing them to kind of hold. And so the reason we go with 4 is we figure that if directionally, statistically, that we can get those indicators to kind of shift in our direction, that we're probably headed in the right direction, just by the fact that we know that all 6 of them tell us kind of which way the market's going, and we can compound those percentages of them being right in hopes that directionally we're correct.
So we actually back tested the Asbury sticks.
Okay.
Not because we use it to trade. It's really active. It trades about 12 round turns a year, right, Jack? Going back 6, 7 years.
Yes.
So it's too agile for a lot of investors that don't want to be that jumpy with their trading. But we've been tested it, and over the 7 years, it has stuck like glue to the S&P 500, which has been about a 12.5%-ish annual return going back those 6 or 7 years. But the difference is the maximum drawdown in the S&P 500 was 34%. That was during COVID.
I was covered with 20.
The maximum drawdown, if we're just following the A6 signals, which is if it's 4 or more green, you're in, and if 4 or more red, you're out and you're in cash. That maximum drawdown was 13.5%. So it's 2/3 less of a drawdown with the same, still being able to capture the S&P 500. So if somebody's willing to spend that much time trading, 12 times a year, it's active. I don't use it as a signal like that. Rarely I do. And sometimes I do it with a little bit of leverage because the drawdowns are so much better. But that kind of explains the veracity of the metric. It gets you out of there quick, but otherwise it generally captures what the market gives you.
So are we, right now, just to kind of recap what we looked at, we had all 6 of them were red. Is that right? Yeah, like and we're at a major support level, and VIX is high. Is VIX one of the Asbury 6?
It is.
Or is that okay. When was the last time that all 6 of them were red at a major support level? Do you remember?
At everyone.
All of the market announcements. Yeah.
Because the A6 is it's agile. It moves fast on purpose. So usually by the time the market drops far enough to go back down to a major trend line or a 200-day moving average or some kind of major support proxy like that, it's spent enough time going down to trigger all 6. So all 6 will be red.
Right.
I'm seeing now is, okay, so we know it's red, and it's been red since February the 21st. So we've missed 6 or 7% of this move down. The trick is, how do you know it's safe to get back in? So that's the question to ask right now. So what generally will happen is maybe you want to explain this, but it's an incremental move kind of back towards green.
Yeah, so we'll start to see them shift, right? VIX will flip first, and then we'll start to see some of the other metrics kind of come in. Monthly rate of change tends to have a relatively quick flip, but they'll start to kind of tack on. We'll start to see them trend in the right direction. One of the other things I kind of look at a little bit separately from the A6 is I look at the S&P 100 a lot in convergence also with a VXX, which is the short-term VIX, and trying to see, am I seeing direct, leaders kind of take over? So, the 100 is going to be the top market cap, and I want to see those guys start to lead over and the VIX flip under its 21-day moving average. This way I can say, okay, well, not only do I see the threat meter, which is the VIX, come down to a more common level, but I'm also starting to see leadership with the top 100.
It's kind of cause and effect, right? The first thing that has to happen is the fear needs to start to abate so people can go in the market and buy again. When the market's terrified, there's not a lot of buying. So when the VIX is really high, you tend to see less risk taking, like some market trading.
People sell first and ask questions later.
That's right. So at some point, S&P down 120 now. So at some point, that fear is going to start to abate, and the VIX is going to come down to a level that will turn it green on the Asbury 6. So the next thing that you want to see then is buying. So Jack actually he actually pointed this out to me, but he looks at the S&P 100 versus the 500. So you're looking at the largest stocks, the 100 of the 500, the 100 biggest stocks, and then the other 400 are behind it. That often leads. So VIX down, and then you start seeing outperformance by the 100 over the 500, and now you're starting to get a sequence of events here. The market's calming, and the market is starting to go back into the bigger, a little bit maybe less risky of the 500, the bigger names, the more well-known names. And that kind of helps us to tell the story from the inside out. Instead of saying, well, I think, Washington's got it figured out now, and Trump might say this, or interest rates are going to do that. We're watching that sequential change in how afraid the market is and how much subsequent risk take is going.
I noticed in the report you talked a lot about the uncertainty. I was reading it. It was really interesting, actually. But you talked a lot about the uncertainty and the tariffs being risk on, risk off. Do you think it's more the uncertainty, or do you think tariffs are inherently bearish or bad for the markets?
It could definitely be both, right? Broad-based tariffs in an economy that's already worried about inflation can, cause some people to be inherently a little bit nervous, right? Broadly in the markets, what I've noticed, it's definitely the uncertainty. Managers tend to have a pretty good sense of, if how to react to news. But if you don't know if that news is going to change on a hourly or a daily basis, that causes the uncertainty that most managers don't want. So, broader economy, like I said, I think, we do broad-based tariffs. Some economists say it's positive because it, brings investment back to the U.S. Other economists say that it really hurts the average individual who's going to buy eggs or milk at the store. But broadly, for Asbury purposes, we try to, that's more my opinion than what we're offering. As a company, we really like to stay out of that. That's why we kind of focus so much on data.
We follow the money.
Yeah, you can get whipsawed by, watching everybody else's opinion on a daily basis. 24-hour news, everybody always has to have an opinion. So you're kind of chasing your tail on that. But, we really focus on the raw numbers. That's why we like A6 so much. The A6 does not have an opinion on Trump's tariffs, but it does have an opinion on where the market's at.
Hey, Saki. This has been, this for me has been great. It's very topical. It's really, really to the point. Maverick asked a question. Do you do active trading in your own personal accounts?
Every penny, except for a little bit of fixed income of my own money, is following my own models. I eat my own cooking. And I do that because these models, at Asbury Research as a firm, is the product of doing this for 40 years and loving it every day and trying to come up with better, safer, more reliable ways to trade the market. So yeah, I trade all of our models. I use leverage in some of those to try to get a little bit more bang for my buck. When opportunities are right, when T-bills were paying 5%, I bought some P-bills because it was a layup. And when the market gives you layups, you take them. But most of my money is and has been for many years invested in our own models.
That's very cool. When you say you leverage, do you do options or are you doing primarily just buying the ETFs or the double ETF?
Doing 2 and 3 times leveraged ETF.
Okay.
Like 6, the Asbury 6, because of the low drawdown that I explained, I used for my own account. That's too much inside baseball, but for my own, I trade the Asbury 6 with some leverage. I don't do that for a large portion, but we have the ability here in-house to be able to take our different models, assemble them into a portfolio, right? So I might have 20% of this model, 30% of that model, 17% of that model. And then we can back test those 5 to 7 years back, which is our sweet spot in terms of back tests. And we can see what our maximum drawdown is, what our Sharpe ratio looks like, what our Sortino ratio looks like, what standard deviation will look like, and get very mathematical, clear understanding of during that period. We can't look forward. So all we can do is look back, what to expect. What was the biggest drawdown we had? How jumpy is my P&L? Standard deviation will tell you that. So having the advantage of having multiple models and be able to kind of mix them together like a stew until you get the flavor you like, that's something we do too for my own money.
Maverick wants to know a price point. Like typically, what does one of the models cost? Is all of the go ahead.
The premium service, the research service, is $499 for 3 months, $17.99 for 12. That's for individual investors. If you're an RIA, if you're managing money, for other people, that's another. It's another service and it's another level of pricing that's going to be for that. And again, we also have Substack. What do we say? It was asburyresearch.substack.com. And there's a free product there that's just one chart a week. It's a chart of the week. It'll be one of those charts that you saw or something like it once a week. And then we've got a $25 a month. I'll let you talk about that.
Yeah, so we have a $25 a month option. It comes with our chart focus, which is our 9 charts or 10 charts a week that we find are highlighted good, as well as we also have what we call a sort report, which is a high level.
I have to share that, or can they? Oh, yeah. Oh, sure. I don't know if you can see that, Jeff.
Not yet.
We're going to do a fast share.
So we have for Asbury Research sort report. And what this does, this comes out twice a week. And we're kind of a top-down approach. We want to give our investors an idea of where they should be looking to put, to deploy their money. All 3 green across to say that's theoretically a good opportunity. So right now we have gold, global equities, XUS, and AGG Ag, which is our interest rates kind of moniker here. So this comes out twice a week for our Asbury Research or our chart focus subscribers on Substack as well.
So it's basically saying the opportunity in terms of trend, relative performance, and money flows right now in gold, global equities, which we looked at some of those a little bit ago, and U.S. interest rates. That would be, the price and not the yield going up. And then the ones to avoid right now is U.S. small cap and crude oil. You could see those down at the bottom when they have red all the way across those 3 different categories.
Okay. It's good. Let's see. I think, and then people can find out more about that at asburyresearch.com.
Correct.
What is the most enjoyable part of what you do for a living?
He's going to say working with his dad.
Yes, but you don't have to lie to us.
We come in every day and it's different, right? The markets are going to do something slightly different. There's interpretation to do. And for us, it's this puzzle, and it's a nonstop puzzle, right? It's a puzzle that you can never quite finish. And I think trying to solve it every day is really enjoyable. We also, we're a small company too. So we got to be nimble. We got to be on our feet and tackling different problems. But I think, for fun, even after work ends, we're like sending each other charts and highlighting different things that we saw. And, hey, what is this? How does this chart work? Or maybe we can combine these 2 items. So I think, broadly trying to solve the market. I don't think anybody's officially done that yet, but attempting to do it every day is quite fun.
What's the hardest part?
Solving the market. It wasn't so hard as fun, right? Trying to achieve and get an understanding of what we're doing every day. That part's just as hard, but I don't think it would be fun if it wasn't hard.
The other thing for me is, I came up on the trading floor and I worked for some big firms. I worked for Shearson American Express back in the day and Deutsche Bank and Atlas Markets. And Wall Street, everyone wears the same shoes and wears the same suit. And it's very, people that have their own ideas and like to kind of go off the grid a little bit are not widely appreciated in Wall Street, or at least part of Wall Street that I was associated with. I've always been an entrepreneur. I've always wanted to have my own thing. I didn't like this follow the leader kind of mentality. It's just the Wall Street mentality I'm kind of a cat. I kind of like to wander off, rather than go through. And having my own business, even in the beginning when I wasn't really making a lot of money at this, it was my own thing. I could develop my own ideas. I could try to build a model where I wouldn't be able to do that in another shop. I'd be told to shut up and do my job. So a lot of the development of the stuff that we've put together is my ability to get up every morning, and if I have a good idea, I can go chase it.
Awesome. I can't believe we've spent an hour already, but I want to thank you guys for coming in, spending some time with us. This session was kind of so much more topical for where we're at right now than it usually is. I'm going to make sure we get it up onto YouTube fast, but I really appreciate the insight and I appreciate you guys coming and spend another hour with us.
It's fun. I've been using Metastock for, I don't know, you guys should send me a gold watch. I think it's probably like 25 years or something. And everybody there in terms of customer service that I've dealt with over the 20 years or whatever, it's been great. It's a great company. So I like being with you guys.
Yeah. I love having you on. That was a great session. Thank you for spending some time with us and sharing some nuggets.
See you soon.
All right. Thanks, guys.